Today we are going to take a look at 5 key valuation metrics value investors like Warren Buffett or Charlie Munger are using to rate companies and stocks. And these key figures can help you to find out whether a company is valued too expensive or too cheap on the stock exchange market. Hi, my name is Björn from Become Financially Independent, and since I have received a lot of inquiries in the past about how to correctly evaluate companies and how one can look in particular at whether stocks are overvalued or undervalued in order to then deduce whether the stocks will rise or possibly fall in the future, I thought I will present you the most important key values value investors are using when looking at the company. However, there are a few points to consider in advance before we look at one key figure after the other. First of all, it is important to understand that a key figure alone has absolutely no meaningfulness. If I say, for example, that the company is rated with a PE ratio of 15, you can do nothing with this information because you don't know the rest of the story. Hence, it is always important to see the key figures in their context, which means when we have a price earnings ratio, a PE ratio, we first have to look at it historically. So how has the PE ratio developed from the past to today and how you suspect it will develop in the future. And secondly, you have to see this key figure in comparison to the competitors, means the companies that work roughly the same industry or in the same market environment. Therefore, it would make relatively little sense to compare, for example, a car company like Tesla with Google or Facebook, because the key figures are very different here. This is simply because the business model is completely different. Some companies are very cyclical, for example, which means that they are very dependent on the fluctuations of the economy. That there are others that are less cyclical, and others have high investments such as in machines or factories, while there are other companies that do not need any machines, factories or buildings or whatsoever, but have on the other side a very high personal costs like insurance companies or banks, for example. Key figures must always be seen in context and always compared. Only then they have a meaningfulness. The second and the most important hint is that you should never invest in a company that you have not fully understood. It is therefore important to have really looked at the entire annual report to have it fully understood. Possibly to have read analyst assessments and to have studied the key figures. Otherwise, there can always be a nasty surprise and you buy a pig in the poke. So it's important that you get the overall picture. That means that you understand the company, understand the business and how this company earns its money in the first place. Which are the respective competitors, what is the position of the company compared to the other companies, how does the market work, what growth per year is there in the market in general, and what growth potential does the company have, and so on and so on. And the next 5 key figures are of course not complete. That means they are not enough to fully understand the company, but they give you a rough orientation to start a possible first filter process. And at the end, as a little extra, I will give you an example why just not to trust some numbers and values. But with further ado, let's start right away with the first key figure. The price to earnings ratio or PE ratio is a metric that helps investors like you to determine the market value of a stock compared to the company's earnings. In short, the PE ratio shows what the market is willing to pay today for a stock based its past or future earnings. The PE ratio is important because it provides a measuring stick for comparing whether a stock is overvalued or undervalued. A high PE ratio could mean that the stock price is expensive relative to earnings and possibly overvalued, like NIO for example. A low PE ratio might indicate that the current stock price is cheap relative to earnings. I say might, as you will see later on an example where a stock is undervalued but in a really negative way. Since the ratio determines how much an investor would have to pay for each dollar in return, a stock with a lower PE ratio relative to companies in its industry costs less per share for the same level of financial performance than one with higher PE ratio. Value investors can use the PE ratio to help find undervalued stocks. And the next one would be the price to book ratio, or PB ratio. And the PB ratio measures whether a stock is over or undervalued by comparing the net value, the assets minus the liabilities of a company to its market capitalization. Essentially, the PE-PB ratio divides a stock share price by its book value per share, BVPS, and the PB ratio is a good indication of what investors are willing to pay for each dollar of a company's net value. The reason the ratio is important to value investors like you is that it shows the difference between the market value of a company's stock and its book value. The market value is the price investors are willing to pay for the stock based on expected future earnings. However, the book value is derived from a company's net value and is a more conservative measure of a company's worth. A PB ratio of 0.95, 1 or 1.5 means the underlying stock is trading at nearly book value. In other words, the PB ratio is more useful the greater the number differs to 1. To a value-seeking investor, a company that trades for a PB ratio of 0.5 or even below is attractive because it implies that the market value is 1/2 of the company's stated book value. Value investors often like to seek out companies with the market value less than its book value, and then they hope that the market perception turns out to be wrong. By understanding the difference between market value and the book value, you can pinpoint investment opportunities. That is, for example, what Warren Buffett and Charlie Munger have been doing and still doing. And now, the debt to equity ratio. The debt to equity ratio, the DE, is a stock metric that helps investors determine how a company finances its assets. The ratio shows the proportion of equity to debt a company is using to finance its assets. A low debt to equity ratio means the company uses lower amount of debt for financing versus shareholder equity. A high debt equity ratio means the company derives more of its financing from debt relative to equity. Too much debt can pose a risk to a company if they don't have the earnings or cash flow to meet its debt obligations. And as with the previous ratios, the debt to equity ratio can vary from industry to industry. A high debt to equity ratio doesn't necessarily mean the company is run poorly. Often debt is used to expand operations and generate additional streams of income. Some industries with a lot of fixed assets, such as the auto and the construction industry, typically have higher ratios than companies in other industries. That you can see very well on Tesla, for example. Now we come to the free cash flow, or FCF. An FCF is the cash produced by a company through its operations, minus the cost of expenditures. In other words, free cash flow is the cash left over after a company pays for its operating expenses and capital expenditures, CapEx. Free cash flow shows how efficient a company is at generating cash and is an important metric in determining whether a company has sufficient cash after funding operations and capital expenditures to reward shareholders through dividends and share buybacks. That you could really see, for example, as well what Berkshire Hathaway was doing this year or last year. They were buying a lot of shares back, for example. And free cash flow can be an early indicator to value investors that earnings may increase in the future, since increasing free cash flow typically means that earnings are increasing. If a company has a rising FCF, it could be due to revenue and sales growth on the one side or cost reductions on the other side. In other words, rising free cash flows could reward investors in the future, like for example with dividends, which is why many investors cherish free cash flow as a measure of value. When a company's share price is low and a free cash flow is one on the rise, the odds are good that the earnings and the value of the shares will soon going up. Let's come to the Pac ratio, the price earnings to grow ratio. Pac is a modified version of the PE ratio that also takes earnings growth into account. The PE ratio doesn't always tell you whether or not the ratio is appropriate for the company's forecasted growth rate. The Pac ratio measures the relationship between the price earnings ratio and the earnings growth. The Pac ratio provides a more complete picture of whether a stock's price is overvalued or undervalued by analyzing both today's earnings and the expected growth rate. Typically, a stock with a Pac of less than 1 is considered undervalued, since its price is low compared to the company's expected earnings growth. A Pac greater than 1 might be considered overvalued, since it might indicate the stock price is too high compared to company's expected earnings growth. Since the PE ratio doesn't include future earnings growth, the Pac ratio provides a more complete picture of a stock valuation. The Pac ratio is an important metric for value investors since it provides a future-looking perspective. So now we have a little overview and know some values, and I encourage you to go, for example, to Finviz and play a bit around and search some stocks and get familiar with it. And as I promised, here an example with ABX. As I said in the beginning, that you have to see the full picture and you have to get to know the company, as you can see here, the search results, and now you see why it is so cheap. So always do your homework and not just trust some numbers. And by the way, let me know in the comment box below how you analyze companies and what is important for you and where you look for before investing in a company. And before we finish, I just want to mention that for each one I will do separate videos, and there I will show and explain how you can calculate and which formula to use for each one of them. So maybe consider subscribing. That's it for today. Thanks for watching, and as always, stay focused and don't get greedy.